Here's why 95% of retail crypto traders consistently lose money to institutions. They don't understand market structure. While retail traders focus on charts and technical indicators, professional institutions are operating in a completely different game. They understand order flow, liquidity provision, market making, and the hidden mechanics that actually determine price movements. In this comprehensive guide, I'll pull back the curtain on how cryptocurrency markets really work, who the major players are, and how you can start thinking like an institution instead of being their counterparty. To understand why retail traders struggle, you first need to understand the hierarchy of market participants and how each level operates with different advantages. Tier 1: Market makers and exchanges. At the top of the food chain are market makers, firms that provide liquidity by continuously quoting bid and ask prices. They profit from the spread between these prices and have several key advantages: access to order flow information before it hits the public market, ability to see pending orders and adjust pricing accordingly, sophisticated risk management systems that adjust in real time, direct relationships with exchanges for reduced fees and faster execution. Tier 2: Institutional traders and hedge funds. These are professional trading firms with significant capital and resources, advanced algorithms that can process information faster than humans, access to private deal flow and early investment opportunities, sophisticated risk management and portfolio optimization tools, professional research teams, and direct relationships with projects. Tier 3: High net worth individuals and family offices. Wealthy individuals and their investment vehicles. Access to private placements and pre public investment rounds. Professional advisors and institutional quality research. Ability to move significant amounts without retail level slippage. Tax optimization strategies, and sophisticated portfolio management. Tier 4: Retail traders. Individual investors trading through public exchanges, limited access to information and research, higher fees and worse execution than institutional participants, emotional decision making without systematic risk management, subject to manipulation by higher tier participants. This hierarchy explains why retail traders are often the counterparty to institutional profits. They're playing a different game with different rules and information. Understanding how prices are actually determined is crucial for making better trading decisions. The order book mechanism. Price discovery happens through the interaction of buy and sell orders. Bid orders: what buyers are willing to pay; ask orders: what sellers are willing to accept. The spread: the difference between highest bid and lowest ask. Market orders: execute immediately at current market price. Limit orders: execute only when price reaches specified level. Liquidity and market depth. Liquidity refers to how easily you can buy or sell without affecting price. Deep markets: large orders can be filled without significant price impact. Shallow markets: small orders can cause large price movements. Market makers provide liquidity by maintaining continuous quotes. Liquidity varies significantly across different crypto assets and times. Hidden order flow: much of the real trading happens away from public view. Dark pools: private exchanges where large orders can be executed without revealing information. Over-the-counter OTC desks: direct trading between institutions. Cross-trading: matching buy and sell orders internally within institutions. This hidden flow can be 60-80% of actual trading volume, front-running, and information asymmetry. Institutions often see retail order flow before it executes. Payment for order flow: retail brokers sell order information to market makers. Predictable patterns: retail traders often use similar strategies and indicators. News advantages: institutions often receive information before it becomes public. Technical advantages: faster execution and better technology infrastructure. Market makers are the hidden engine that keeps crypto markets functioning, but understanding their role helps explain many price movements. How market making works. Market makers continuously quote bid and ask prices for crypto assets. They profit from the bid-ask spread, not from directional price movements. Use sophisticated algorithms to adjust quotes based on market conditions. Manage inventory risk by hedging positions across multiple venues. Provide liquidity that makes it possible for retail traders to execute orders quickly. Market maker advantages. Professional market makers have several structural advantages. Rebates from exchanges for providing liquidity. Access to co-located servers for faster execution. Sophisticated models for pricing options and derivatives. Ability to see order flow patterns and adjust accordingly. Impact on price discovery. Market makers significantly influence how prices move. During low volatility, they narrow spreads and provide stable pricing. During high volatility, they widen spreads and may withdraw liquidity temporarily. Around news events, they adjust quotes based on expected volatility. Their algorithms can amplify or dampen price movements. Retail implications, understanding market making helps retail traders time trades for better execution during high liquidity periods. Understand why spreads widen during volatile periods. Recognize when liquidity is artificially thin, potential manipulation. Use limit orders more effectively to avoid paying excessive spreads. Professional institutions use sophisticated strategies that retail traders rarely understand or have access to. Algorithmic trading systems. Institutions employ complex algorithms for trade execution. TWAP, time weighted average price, breaks large orders into smaller pieces over time. VWAP, volume weighted average price, executes trades based on historical volume patterns. Implementation shortfall balances market impact against timing risk. Statistical arbitrage exploits price relationships between correlated assets, cross market arbitrage. Professional firms profit from price differences across venues. Exchange arbitrage, price differences between different crypto exchanges. Basis trading, exploiting differences between spot and futures prices. Cross currency arbitrage, taking advantage of exchange rate inefficiencies. Geographic arbitrage, price differences across different regulatory jurisdictions. Market neutral strategies, institutions often avoid directional market risk. Pairs trading, long one crypto, short a correlated crypto market making. Profit from spreads without taking directional risk. Delta neutral option strategies, profit from volatility without price direction risk. Statistical mean reversion, exploiting temporary price deviations. Information edge strategies. Professional traders often have access to better information. Fundamental analysis, deep research on project developments. Sentiment analysis, sophisticated social media and news monitoring. Order, flow analysis, understanding retail trading patterns. Macro analysis, connecting crypto markets to broader economic trends. Derivatives markets often drive spot price movements more than spot markets themselves. Futures market influence. Bitcoin and Ethereum futures often lead spot price movements. Futures allow for easier short selling and hedging. Institutional participation is often higher in futures markets. Basis, difference between futures and spot, provides arbitrage opportunities. Futures settlement dates can cause significant price volatility. Options market dynamics. Options trading affects underlying asset prices through several mechanisms. Gamma hedging. Market makers hedge option exposure by buying, selling. The underlying Max Pain theory, prices gravitate toward levels that cause maximum option losses. Volatility trading, options provide pure volatility exposure separate from price direction. Put, George, call. Ratios indicate market sentiment and potential reversal points, perpetual swaps, and funding rates. These derivatives, unique to crypto, create interesting dynamics. Funding rates balance long, short interest in perpetual contracts. Extreme funding rates often indicate market tops or bottoms. Cross-exchange funding rate differences create arbitrage opportunities. Retail traders often misunderstand funding rate implications. Leverage and liquidations. High leverage in crypto creates cascading effects. Long liquidations create selling pressure and drive prices down. Short liquidations create buying pressure and drive prices up. Institutional traders often position to benefit from retail liquidation cascades. Understanding liquidation levels helps predict support and resistance. Large holders, whales, operate very differently from retail traders and significantly impact market structure. Whale trading patterns. Large holders have different constraints and strategies. Must break large orders into smaller pieces to avoid market impact. Often use OTC markets to avoid revealing their intentions. Time their trades around market conditions and liquidity. Use sophisticated execution algorithms to minimize slippage. Accumulation and distribution phases. Whales accumulate and distribute positions over extended periods. Accumulation, quietly building positions during low volatility periods. Distribution, gradually selling positions during high retail interest. These phases often last months and are invisible to retail traders. Technical analysis patterns often reflect institutional accumulation, distribution. Market impact management. Large traders use various techniques to minimize their market impact. Iceberg orders show only small portions of large orders. Time-based execution, spread trades across multiple time periods. Volume-based execution, trade proportional to normal market volume. Dark pool usage, execute without revealing order information. Coordination and herding. Large institutions sometimes coordinate or follow each other. Institutional herding during major market moves, following the actions of successful hedge funds or institutions. Coordinated responses to regulatory or market developments. This coordination can create self-reinforcing price trends. Understanding how exchanges operate reveals potential manipulation tactics and structural advantages. Exchange revenue models. Crypto exchanges have various ways to generate revenue: trading fees, percentage of each trade executed, listing fees, payments from projects to list their tokens, market making. Some exchanges trade on their own platforms, lending and derivatives, additional financial services. Potential conflicts of interest. Exchange operations can create conflicts. Insider trading, advanced knowledge of listings or delistings, front running, executing orders ahead of customer orders, market making conflicts, trading against their own customers, manipulation through wash trading or artificial volume, regulatory arbitrage. Exchanges operate under different regulatory frameworks. Offshore exchanges offer different products and leverage levels. Regulatory uncertainty creates opportunities for manipulation. Jurisdictional shopping allows exchanges to optimize for profitability. Different rules for different customer types, retail versus institutional. Technical infrastructure. Exchange technology creates advantages for some participants. Co-location, physical proximity to exchange servers for faster execution, API access, direct programmatic access versus web interfaces. Order types, sophisticated order types available only to certain participants. System overload. Some exchanges prioritize certain order types during high volume. Professional traders look for market structure signals that reveal institutional activity and potential price movements. Volume profile analysis, understanding where volume occurs, provides insights into institutional activity. High volume nodes, price levels where institutions have significant interest. Low volume areas, prices likely to move quickly through these levels. Volume at price, understanding the distribution of trading activity. Institutional footprints, identifying patterns of large order execution. Order, flow imbalances, analyzing the flow of buy and sell orders. Bid-ask imbalances, more aggressive buying or selling pressure. Large order detection, identifying institutional size transactions. Time and sales analysis, understanding the pace and direction of trading. Hidden liquidity detection, finding where large orders are waiting. Cross-market analysis, looking across different markets for confirmation. Spot futures basis. Institutional hedging and arbitrage activity. Cross-exchange price differences. Arbitrage opportunities and liquidity flows. Correlation breakdowns, when normal relationships break, indicating institutional repositioning. Options flow, large options trades that indicate institutional positioning. Sentiment divergences, when market sentiment differs from price action. Retail FOMO while institutions distribute, often marks market tops. Retail panic while institutions accumulate, often marks market bottoms. Funding rate extremes, when leverage becomes too one-sided. Social sentiment versus on-chain activity. Actual behavior versus expressed sentiment. Understanding market structure should change how you approach crypto trading and investing. Timing your trades. Use market structure knowledge to improve execution. Trade during high liquidity periods for better execution. Avoid trading during known institutional rebalancing times. Understand when spreads are likely to be wider or narrower. Time entries and exits around institutional flow patterns. Position sizing and risk management. Adjust your approach based on market structure realities. Account for higher slippage in smaller cap assets. Understand that correlations increase during market stress. Plan for liquidity to dry up during volatile periods. Use limit orders more effectively to avoid paying excessive spreads. Information interpretation. Filter information through a market structure lens. Understand who benefits from certain narratives or news. Recognize when retail sentiment diverges from institutional positioning. Identify potential manipulation attempts in thinly traded assets. Use multiple information sources to verify important developments. Long-term strategic thinking. Adopt institutional-like approaches to portfolio management. Focus on risk-adjusted returns rather than absolute returns. Understand the difference between alpha and beta in crypto markets. Build positions over time rather than making all or nothing bets. Develop systematic approaches to reduce emotional decision-making. Market structure continues to evolve as crypto markets mature and institutional adoption increases. Increasing institutionalization. Traditional finance infrastructure is being adapted for crypto. Prime brokerage services for institutional crypto trading. Sophisticated custody solutions for large holders. Traditional market-making firms entering crypto markets. Regulatory frameworks becoming more defined and predictable. Technology evolution. New technologies are changing how markets operate. Layer 2 solutions reducing transaction costs and increasing speed. Decentralized exchanges challenging traditional centralized model cross-chain infrastructure, enabling more sophisticated arbitrage, AI, and machine learning algorithms, becoming more sophisticated regulatory development. Evolving regulations will reshape market structure. Clear regulatory frameworks reducing uncertainty, traditional financial regulations being applied to crypto, international coordination on crypto market oversight, potential for new market structure regulations specific to crypto. Understanding market structure is the difference between trading as a sophisticated participant versus being someone else's counterparty. This knowledge won't guarantee profits, but it will help you make more informed decisions and avoid many of the traps that catch retail traders. Here's how to continue developing your market structure understanding. First, subscribe to this channel for more institutional level crypto education that focuses on the underlying mechanics and professional approaches to cryptocurrency markets. Second, start observing markets through this new lens. Look for the patterns and behaviors we've discussed rather than just focusing on price movements. Finally, share in the comments what surprised you most about crypto market structure, whether it's the role of market makers, the impact of derivatives, or the influence of institutional order flow. Let me know what clicked for you. Remember, markets are not random. They're the result of the structured interaction between different types of participants with different advantages, information, and motivations. Understanding this structure is your first step toward trading more like an institution and less like retail.